Right now, you probably have a savings account earning 2% interest and a credit card balance you are paying 18% on. Mathematically, that is a catastrophe you are choosing every month. But it doesn't feel like a choice. It feels completely normal. That is not a discipline problem. Your brain built a wall between those two piles of money, and that wall is invisible, irrational, and engineered by the same system that decides a tax refund is guilt-free spending money. Phenomenon. You have done this. You received a tax refund, maybe $800, maybe $1,200, and within 2 weeks, it was gone. Not on rent, not on debt, on something that felt justified in a way your regular paycheck never quite does. A weekend trip, a jacket you had been watching, a dinner that cost 3 times what you would normally spend. And when it was over, you did not feel bad. It felt earned, separate, like the rules that apply to normal money simply did not apply to that money. Now try to recall the last time your regular salary hit your account. Did you celebrate? Did you spend freely? Almost certainly not. You sorted it. Bills here, groceries there, savings maybe, expenses you already anticipated. The paycheck gets managed. The refund gets spent. The dollars are identical. They will buy the same things. They carry the same legal and mathematical value. But they do not feel identical, and that feeling is not a quirk of your personality. It is a system running inside every human brain, invisible and automatic, that assigns different psychological weight to money based entirely on where it came from. Richard Thaler named it mental accounting, and it is costing you more than almost any other financial habit you have. Mechanism. You were handed a cognitive framework you did not ask for and cannot easily override. In his landmark 1999 paper in the Journal of Behavioral Decision-Making, Richard Thaler described mental accounting as the set of cognitive operations humans use to organize, evaluate, and track financial activities. The key word is organize. Your brain does not hold money in one unified pool the way a bank account does. It sorts money into separate psychological accounts, each with its own rules about what it can and cannot be spent on. Where the money came from determines which bucket it lands in. A regular paycheck goes into the earned income bucket, which carries implicit rules. Pay bills, cover necessities, be responsible. A cash gift, a rebate, a lucky find, these land in windfall buckets where the rules are looser, or spending feels justified because the money was unexpected and therefore somehow doesn't count against you. Thaler demonstrated that this sorting happens automatically, below conscious awareness. We are not deciding to treat the refund differently. The categorization has already occurred before you make any spending decision at all. The bucket exists first. The spending rationale follows. And here is what makes this a genuine financial trap rather than a harmless quirk. Money in different buckets is not treated as interchangeable. A 2023 systematic review by Silva and colleagues in the Journal of Behavioral and Experimental Economics confirmed that this non-fungibility, the brain's refusal to treat identical dollars as identical, is one of the most robust and replicated findings in behavioral economics. The non-fungibility goes deeper than where money comes from. It also tracks what money is mentally designated for, and this is where the system compounds its damage. In a 2014 study published in the Journal of Behavioral Decision-Making, Helion and colleagues examined gift cards and found that consumers reliably used gift card balances for more hedonic, indulgent purchases than they would have made with cash of the same value, even when the gift card was for a general retailer with no category restriction. The money was identical. The purchasing power was identical. But the gift card balance existed in a separate mental account, one with different rules, where spending on pleasure felt more permitted. Your brain runs dozens of these sub-accounts simultaneously. There is the account for your children's needs, which feels non-negotiable. There is the account mentally earmarked for the holiday you are planning, which feels protected and purposeful. There is the account you have quietly assigned as your emergency fund, which feels untouchable even when an emergency arrives and you reach for credit instead. And there is the credit card account itself, which often operates in its own psychological space, where spending does not feel like spending at all because the money has not left your hand in any tangible way. Thaler, in his foundational behavioral economics work published throughout the 1980s and 1990s and synthesized in his book Misbehaving, called this the pain of paying, and he demonstrated that the more psychologically abstract the payment method, the less pain you register, and the more you spend. The buckets are not just categorizing your money, they are changing how much of it you use. If you want to stop being the person this works on, hit subscribe. We decode a new manipulation system every week, and knowing it is the only defense that actually holds. Let us keep going. Trap. Here is the most expensive mental accounting trap in the average household. The one hiding in plain sight on millions of balance sheets right now. You carry credit card debt at 16, 18, sometimes 24% annual interest. At the same time, you maintain a savings account paying somewhere between 2 and 5%. You do not move the savings to clear the debt. The idea feels wrong somehow, reckless even, like you would be destroying something important. So you pay the minimum on the card, you earn almost nothing on the savings, and every month the gap between those two rates quietly extracts money from you. This is pure mental accounting at its most damaging. The savings account lives in the protected bucket, the security bucket, the responsible adult bucket. The credit card debt lives in a separate account entirely, one associated with past spending decisions that already happened. Because they are in different psychological compartments, your brain does not perform the arithmetic that would reveal they should cancel each other out. The rational move, clear the high-interest debt with the low-yield savings, never gets computed because the brain never puts the two numbers in the same room. Thaler documented this exact pattern and described it as one of the clearest demonstrations that mental accounting violates the basic economic assumption of fungibility. Money is not money when it is sorted into buckets. It becomes something else, protected, purposeful, contextual, and strategically immovable in ways that benefit no one except the financial institutions collecting the interest spread between your two accounts. The source illusion runs on the same mechanism and produces some of the most financially destructive decisions people make. A tax refund is money you overpaid in tax throughout the year. It was earned income, your paycheck, just temporarily held by the government and returned to you with no interest. By any rational measure, it is identical to money you receive on a Friday afternoon from your employer. But it does not feel identical. The refund lands in the windfall bucket, the unexpected gain bucket, and the rules of that bucket say, this was never in my budget, so it doesn't have to go toward anything budgeted. It can be spent freely. Soman's 2001 research in the Journal of Behavioral Decision-Making extended Thaler's framework to show that the same psychological segregation applies to time, that the source and context of a resource changes how liberally people use it, regardless of its objective value. The principle is identical for money. Framing determines the bucket, and the bucket determines the behavior. Godek and colleagues, writing in 2011 in the Journal of Behavioral Decision-Making, found that people's spending decisions around fuel costs shifted dramatically based on how the price change was framed and categorized, demonstrating that the same objective financial reality produces completely different spending behavior depending on which mental account people assign it to. The source illusion is not a quirk of how refunds feel. It is a general property of how the human brain handles any resource it has not explicitly accounted for from the start. That property is being exploited every time a retailer offers cash back, a rebate, or a points-based reward system. Defense. The single most powerful thing you can do with this information is collapse the buckets deliberately, and that requires a specific, concrete audit, not a vague intention to think differently about money. Step 1. Write down every distinct pool of money you currently hold: checking account, savings account, credit card balance, gift card balances, cash in your wallet, any pending refund or rebate you are expecting. List them all in one place at the same time. This act alone, forcing the brain to see them simultaneously rather than in their separate psychological compartments, begins to break the non-fungibility illusion. Thaler called this the principle of fungibility, and it requires physical intervention to override the brain's automatic sorting. Step 2. Apply a single interest rate lens to every item on that list. What is the effective rate of return or cost attached to each pool? The savings account is earning 3%. The credit card balance is costing 19%. When you write both numbers in the same column, the arithmetic the brain refused to perform becomes impossible to ignore. Step 3. Institute a rule for all incoming money, regardless of source. Every dollar, paycheck, refund, gift, rebate, bonus, goes into one account before any spending decision is made. This is the mechanical equivalent of making money fungible. The bucket cannot form if the money never lands in a separate space to begin with. The brain will resist this. The windfall will still feel different. Acknowledge the feeling, then override it with the arithmetic. That gap between what money feels like and what it actually is precisely where financial decisions go wrong. Your brain is not broken. The mental accounting system it runs was adaptive, useful for tracking resources in an environment where money did not exist in abstract digital form. The problem is that it is running unchanged in an environment of credit card interest rates, high-yield savings accounts, cashback schemes, and tax refund cycles, all of which were designed by people who understood the bucket system and built their profit models around it. Thaler won the Nobel Prize in Economics in 2017, in part for documenting exactly this gap between how humans behave and how classical economics assumed they would. The gap is not a moral failing. It is a feature of human cognition being systematically exploited. The defense is not to feel bad about the refund you already spent, or the credit card balance you kept while the savings account sat there. The defense is to apply the fungibility principle going forward, to build mechanical systems that treat all money as identical before the bucket has a chance to form. Every dollar you collapse back into fungibility is a dollar the system can no longer trade on your irrationality. If you want to see where this goes next, the free trial you signed up for and never canceled, and the psychological trap that keeps it alive, that is the next video in this series. It uses the same framework, and the numbers are just as uncomfortable. If this changed how you think about money buckets, explore why your phone is designed like a slot machine and how to fight back. Link is on screen now. And if you have not already, hit subscribe. We publish every Wednesday.